So in today's live stream, we're going to start by talking about the dollar or analysis on the dollar and what we're looking forward to see in the marketplace. So last week we had a lot of high volatile news that's created a lot of volatility in the marketplace. We saw this drop into the inefficiency, expansion, price rallied above the high resistance, liquidity resting right here, showing me a telltale sign that the next key level to draw into is this position right here. We'll have an inefficiency resting right here. But personally, I really will be surprised if this key level holds as a strong support level. I wouldn't be surprised for price to rally above this overall high right here. And my reason for that is because we still have this inefficiency right here. We'll still have extreme premium resting right here. Second reason. Third reason, the bodies of the candle, the last impulse move, we still have that resting right here and it's unmitigated on the daily time frame as well. So already I've outlined three reasons why I'm not going to be surprised for that to happen. And the fourth reason is because I do not like this lethargic price action right here. I've literally been saying this all through the time when price made this displacement to the downside, even came lower, mitigated this position. I always stated how much I didn't like this lethargic price action. So if I'm bearish, I want to see an impulse move to the downside. What do I mean by impulse move? This is an impulse move. 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 A huge heavy displacement, and so far, you can see that so far from this high to this low, we never actually had any significant huge displacements besides these two key levels. Those were the only two key levels that we had some level of high volatility. And you can see, comparing that to this impulse move, you can see that we never had anything like this, nothing like this amount of displacements just on one candle, on one daily candle. We never saw that. And if we measure this from the high to the low, that's literally just 1.20%. And this one right here is about 1.63%. And this one, 1.20%. So, that being said, for me to be well assured that we're going to continue to the downside, I want to see a huge displacement similar to this, or this. I would like to see that after mitigating an extreme premium. I would like to see that heavy displacement. And the moment I see that, that's when I'm going to say, yes, now I believe we've topped out. I want to see a heavy displacement to the downside, minor retracement, heavy displacement. If we're bearish, that is the kind of price action I want to see. Once we've topped out, created our overall high for the next quarter, I would like to see displacements potentially running this sell side liquidity. And once this sell side liquidity gets taken, this will be my next drawn liquidity. Now, my overall market direction on the dollar still remains bearish. And the reason, like I've always talked about, is because we still have a swing high, a swing low. And until this swing high gets violated, I'm bearish on the dollar. And if the dollar should for any reason go to the upside to break this high, close above it, then I'll be bullish on the dollar. But if we do not break above this high on the dollar, I'm still going to keep looking for areas the price could mitigate before a continuation to the downside. So that being said, we're going to look at the Euro US dollar as well, counter analysis to see areas that we're going to be working with. So for Euro US dollar, I'm going to use a chart that is a little bit cleaner, so it's easier to understand what I'm looking forward to see in the marketplace. So using a clean chart right here on Euro US dollar, like I said previously, If we look at the 12-month time frame, the structure is bullish. So I'm anticipating for higher prices on Euro US dollar to continue higher. If we go to the monthly time frame, we can see all these low resistance liquidities resting at the upside. And you can see how price created high resistance liquidity at the downside. Right here, this is a high resistance liquidity. Why is this a high resistance liquidity? Because this low right here came to the downside, took liquidity from this previous low before breaking structure. So price is going to find it hard to drop below this low. This high is low resistance liquidity, failed to run liquidity from previous high before dropping. This high is low resistance liquidity, failed to run previous highs liquidity before dropping. This low right here is high resistance liquidity. The reason is because this low took liquidity from this low and then expanded higher. So you can see how I'm looking for areas that price will encounter a lot of resistance in order to run below or above those areas. Price is going to encounter a lot of resistance before it drops below this low. Price will encounter a lot of resistance before dropping below this low. There's not going to be so much resistance if we want to rally above this high. There won't be much resistance if we want to rally above this high. Example, I'm going to show with you an example. This is even looking at the smaller time frame. This is working with 4 hour time frame. This is high resistance liquidity. Look at what happened right there. Price came close to the highs, to the high resistance liquidity level, and look at the level of displacement we saw from that key level to show you how strong this key level is. Yes, we eventually rallied above it, but look at how it rejected price to the downside, impulsively rejecting price to the downside. So even though price was eventually going to rally above it, but it created a lot of volatility, a lot of rejection, displacement before we now eventually rallied to take that liquidity. Like I said, every high and low is liquidity. You just have to know which one is going to be a high resistance liquidity and a low resistance liquidity. And in this case, this is high resistance liquidity. That's why you saw this level of rejection from that position. Now, if we go back to our analysis on the euro, so now we're looking at the euro. We'll go to the weekly time frame. I want to use a clean chart. So on the weekly time frame, we can basically see our overall high and our overall low right there. This is our overall low, overall high. So we're within this range. You can see how nicely priced. Each time price has come into a premium zone, it's created an opportunity to sell. Each time it's coming to a discount, it's created an opportunity to buy. What do I mean by that? This is premium, this is discount. We came into a premium. This was an opportunity to look for a sell. Went to the downside, inefficiency, take profits, you scale out your position. We went into an extreme premium. Right here, another opportunity to sell. Price dropped into an extreme discount, an opportunity to buy. We rallied into a premium, an opportunity to sell. Now we're in a discount. I'm going to share with you another example of how you can look for potential high probability trades. Now, each time price comes into whether it's a premium or a discount, you can use the weekly time frame to look for significant key levels. What are significant key levels? The last impulse move to the opposite direction before we went to the other direction. What do I mean by that? For example, we saw this down push. This right here was the last impulse move before this down push eventually broke structure right here. So this up push right here is a point of interest. We use the bodies of the candle, and you can see very nicely it's resting in the premium zone. The moment price came into this position, you look for a 1 hour break of structure and you sell into a discount. I'm going to use the buy replay to share with you an example. We'll go to the 1 hour time frame. All you're looking for is a break of structure on the 1 hour time frame. And right here, you can see price came into the position. After it tapped in, it created this low, high, and we broke structure right here. The moment we broke that structure, the moment this low right here got broken, this right here was the candle that broke structure and closed below it. The moment you see that, you can use this as your entry, or you can even scale lower to the smaller time frame, look for inefficiency. And right here, we'll have an inefficiency. That can be your entry right there. Use that as your entry. The overall high, stop loss, and then you sell it into the discount zone. So once price mitigates the equilibrium position, you close. So if we go back to the weekly, we look for the equilibrium zone. You can see right here, this line right here is the equilibrium. Look for the nearest inefficiency right here. That will be your exit. You can take it out at a 1:5 risk to reward ratio. And you can see how price delivered nicely into that key level. So all you need to do is work with a weekly point of interest, weekly candle. Once we mitigate the weekly candle, you're looking for a 1 hour break of structure. And right here, 33 pips stop loss is not really a lot. I know a lot of people like to use 5 pip stop loss, 10 pip stop loss, which is great. But at the same time, those kind of stop losses can easily wipe you out. But this is the kind of trade you can place your entry, your buy limit, or your sell limit order, and you move on with your day. Whenever price hits your entry, take profit, you just open your MT4 app and you see you've made money. So this is one way, one trade. I'm going to share with you another example as well. So the same thing we did the previous time. Now, we're not trying to predict where price is going to come into. All we do is to mark key levels. This is a key level, and you can see price mitigated it, and you got one trade off that position. Another key level is this inefficiency. That's another key level. Another key level on the weekly. The moment price mitigates it, the same thing you looked for the previous time is all you're looking for again. You want to see a 1 hour break of structure. We'll have a low, we'll have a high, we'll have a break of structure. After a break of structure, inefficiency is your entry. You can see the inefficiency right here. We mitigated the inefficiency. The overall high, stop loss. Your take profits, you look for the equilibrium zone. This is the equilibrium zone. You look for the inefficiency at the equilibrium zone. Right there is the inefficiency. We can take it out at a 1:7 risk to reward ratio. And right there, you can see take profit smashed. Two trades. One is the 1:5. The second one is the 1:7. Both take profits smashed. Another one, we look for another trade. Still working with the weekly time frame. After this drop to the downside, price took liquidity from this low. We're looking at the last move to the upside before it dropped to take this low. This was the last move to the upside. Every single candle here was trending to the downside. Every single candle except this one. You can see that it was the only candle that went to the upside before we dropped to the downside. Excuse me. We're working with the bodies of the candle. You can see price came to the premium zone, mitigated the bodies of the candle, took liquidity. All we want to see is a 1 hour break of structure from that key level. And right here, we created a low, created a high, broke structure. Right here, I don't consider this a break of structure because there wasn't a candle closure. This is the break of structure. After the break of structure, now we look for potential inefficiency price could come into. Right here, we'll have an inefficiency. Stop loss above the high. Take profits. We'll look for the nearest inefficiency. So right here is our take profit position. You can see the inefficiency right here. Price mitigated that inefficiency from the high, dropped down into the inefficiency, resting at the low. Delivering a 1 is to 3.6. You can just make it a 1 is to 4 risk to reward ratio. So three trades, one is to 5, second one is to 7, third one is to 4, which totals, if you're risking 1% per trade, that's 16% in total. Now, with the current price action, what do I think the market is going to do? Right now, price has mitigated. We're in the discount zone. And throughout last week, I was talking about this key level being a low resistance liquidity. Price can easily smash through this key level. This is low resistance liquidity. So I wouldn't be surprised to see a drop in price to take out this liquidity resting right here. And we're also having efficiency resting right here as well. Another thing to consider is the fact that you can see that so far from this high to this low, we were trending to the downside, creating lower highs and lower lows. You can see that right here. Lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. And then right here, we broke structure. After breaking structure, we created this swing low, swing high. After creating this swing high, we left this low resistance liquidity right here very nicely. Now, this low resistance liquidity, a lot of traders are going to be looking for buys from this key level because this is a demand zone. And it doesn't really mean that you can't get into a good buy from a demand zone. But in this case, we have liquidity resting below that demand zone, which is showing me a telltale sign that most likely we could see a, a further drop to drop below these lows. Now we'll go back to the weekly time frame, basically to do the same thing we've been doing, which is to look for the last move to the opposite direction before an impulsive move towards the opposite direction. What do I mean by that? This was the last move to the upside before a drop. Last move to the upside before a drop. It made move to the opposite direction, which is to the upside, and then we saw a drop. I inverted the chart in order to show this to you just the same way we were looking at sells on euro. So we look at this as it's a sell. So we're not trying to look at it like it's a buy because sometimes this can be very confusing when you've been doing back testing and then all your back testing has been with a sell and now you see a buy and you get confused and you don't really know whether you should take the buy or not. But in this case, TradingView has made it easy. You can just invert your charts to look at it just the same way you were looking at your backtested data. And right here, you can see we had this last move to the upside before it dropped. And this move to the upside took liquidity from a high. After it took that liquidity, all you want to see is the exact same thing. What is it? A 1 hour break of structure. And right here, this is the overall 1 hour low, overall 1 hour high. We broke structure right here. This was a break of structure. This was the last impulse move before it dropped that broke structure. This was the last major impulse. Even though it didn't drop to break structure, we saw this other impulse dropped, broke structure. We put this in a box. This is our key level. Two things are going to happen at this key level. It's either price is going to mitigate inside this box, or it's going to want to run liquidity above this box. The liquidity could be this liquidity here, inefficiency, or most likely even this liquidity. So in order to make it even much easier, you box the entire key level. This is the entire key level we're working with. Bodies of the candle. So it's either we see price mitigate this position, or we run liquidity from this high and then reverse if we're going to continue trending towards the opposite direction. So we go back to our normal time frame. We'll go back to 4 hour time frame to see what this looks like. And on 4 hour time frame, what do you see resting above our key level? Low resistance liquidity. Resting above our key level. So the next thing we do now is to be on the sidelines and wait. Once price comes into our position, you can see this is our candle, the candle we're working with. If we want to make this as easy as possible in order not to be confused, let's say, for example, you have a full-time job or you have a lot of engagements and you don't know how you can get into such trade, you can box the body of the weekly candle that went to the downside, box from the bodies of the candle to the low, put it in the box. After putting it in the box, the next thing you're going to do is to wait for a 1 hour break of structure. So once price comes in here and you see that break of structure from this key level, you can look for a buy for a continuation to the upside. So we'll go to 4 hour time frame. On the 4 hour time frame, you can see low resistance liquidity, inefficiency. We'll go to 1 hour time frame. So overall on the 1 hour time frame, you can see that there was a high, there was a low, there was a break of structure. This high was never retested. We still put our line above it. Now, it doesn't mean for necessity the price is definitely going to come there. But the reason we put a line above it is because this key level is resting directly below the liquidity of this low. And like I said, when we come into this position, when price comes into this position, our focus is number one, this inefficiency. Once price is in here, if it mitigates this inefficiency and we see a shift in market structures to the upside, then we look for buys. But if it comes in here and it drops below it without showing any form of rejection, That means this low is the next draw on liquidity. Once this low gets taken out and we mitigate this position and we see a shift in market structure on the smaller time frame, we'll look for a buy to continue higher. So that is my analysis on Euro US dollar. And if price potentially comes into my key level and I still don't see a shift in market structure, then that means there's no trade for me and I'll just be on the sidelines for Euro. But if I do see price come in there and then see a significant shift in market structure from 5 minutes, 15 minutes time frame to 1 hour time frame, I'm taking a buy. So I hope that has been insightful and you've got some value from this live stream. If you do have any questions, feel free to drop it in the chat. I appreciate you all for tuning in, and I'll talk to you all in the next live stream.